All right, so I just got out of Costco. Damn you, Costco! I'm always spending money there every time. We load up on goods, load up on beef, load up on oranges, and I happen to catch stuff on sale a lot. And of course, the impulsive nature that I have, every now and again, I'll pick up an impulse shopping. Like today I spent $25 on Tupperware. We haven't changed Tupperware in years and years and years and years. So that's an impulse shop. I should have probably waited for it to go on sale, but to be honest with you, I've been sitting there for freaking a year, probably even longer than that, saying, I'm missing this one. I need this one Tupperware thing. I said, I need that. So I bought some Tupperware. All right. So what does this mean? Well, here, let me tell you why I am a value investor. All right, first and foremost. All right, so value investor, what does that mean? That means low price earnings, low price to book, high dividend yield. So that's those three things to be a value. Doesn't matter the size of the company, it doesn't matter international, it just means it's low price to earnings, low price to book, and high dividend yield. All right, so why do I like that? Because valuations determine future performance. Not every time, there's always going to, look at Amazon. Hell, Amazon stock, like 4 years ago, when it first turned a profit and had like 2 cents a share, everyone was like, oh, we don't want that. The price fell off a cliff because you could actually see the PE ratio was at like 1,000, 1,200 or something like that. And now I think the PE ratio is 70. So not every time, this you got to remember, in investing, it doesn't work like this works, this happens, that will happen. There's no positive correlation in any of this stuff that you can hang your hat on. But we know for valuations, a low valuation means usually, historically, means outperformance in the future. Not really debatable that. Now, again, everything has an exception to the rule. There's always an outlier. But this is why I'm a value owner. Because low PE means low valuations. All right, so let's use an inflationary model. Inflationary. Stock market goes and advances with inflation, all right? So that's good. But again, if valuations determine future growth of the stock, well, if it's already highly valued relative to its earnings, are they going to be able to keep up those earnings relative to inflation to justify the high valuations? And the answer is maybe, but there's a lot more risk inherent in that in terms of the upside of the potential of that stock, because you're already trading at a premium. And inflation kicks in, then that may or may not be what slows down that company, because inflation can have a negative effect on future growth. Absolutely. Just because it's inflationary doesn't mean that all stocks will keep up where they are now relative to that rate of inflation. Does that make sense? So inflationary says, yes, the S&P 500 should as a whole keep up with the earnings per share, but that doesn't mean every single stock in that will. All right, inflationary economies can certainly leave some behind, absolutely. And if a stock is already trading at high valuations relative to the earnings, and if an inflationary economy means they're going to have to keep up those earnings double time, which means they're going to have to move fast to keep up those earnings, because they're already trading high valuations. So low value or low PE stocks are more valuable simply because they have lower earnings from the get-go. Now, there's a reason this stuff has low PE. They might be on the back looking up saying, we're about this far from bankruptcy. They might have a change in leadership. They might have there's so many reasons. They just might be beaten down because, they used to do all this trade in China, and now they got to come and do trade in Vietnam, and people are wondering how that's going to shake out. All kinds of different reasons for it to be valued. And just because it's a low valuation does not mean it can't fall further. That's the thing. In fact, a lady on YouTube just posted the other day, buy cheap discount stocks. When it goes back up to par or above par, trade in it for profit. I said, if it only worked that easily. It doesn't work that easily. And that was talking about closed-end funds. So valuations determine future growth by and large. And again, I'm not going to say it's not debatable because there's always an exception rule, but the lower the valuation, the more potential upside. There's more risk because low valuations could mean it might have no valuation pretty soon because it could be going bankrupt. All right, so that's inflation, but how about deflationary? Same thing. So we already talked about deflationary economies, all right? Deflationary already has a high dividend yield, all right? So people who are buying it are already locked into the dividend yield they're getting based on that stock price. But if they reduce the payout in order, because margins are being trimmed, what does that do to the price of stock? Well, yes, it could reduce it, but it's already trading at a high dividend yield to begin with. I hope that makes sense. It's kind of like a bond. The lower the coupon the bond, the more volatility it is. The higher the coupon the bond, the less volatility there is when it comes to the share price. or the price per share of the bond. Same thing with dividend yield. The higher the dividend yield, the less volatility there will be, because even if they have to reduce their dividends, you're already still getting a premium to the dividend yield of what you were getting before, what other competitors are. So if Coke, using my example from yesterday, if Coke has to reduce their dividend payout and their actual dividend dollar that they're paying, well, if they were paying 4% yield, now they got to reduce it. Now it's just a 3% yield. That's a whole different ball game that Pepsi was paying 2, and now they got to reduce it to 1.5. Does that make sense? So they're already starting out a much higher dividend yield than what Pepsi was. That means they have a lot more room to maneuver in order to drop the dividend if they have to keep up with the declining margins, keep up with the profitability. And that's why a value stock in a deflationary economy looks pretty good to me too, because don't forget, one of the reasons is value, because it's lower price relative to earnings as well. So now you get a value stock that's already been beaten around a little bit. Hard to see that. I mean, it could, absolutely, but it's already been knocked down, which is why it's considered a value stock. A low PE ratio, low price book, high dividend yield. And so because it's already been beaten around some, has less to fall to go down to zero, whereas a high price growth stock has more to fall to go down to zero, which makes it, in this case, a deflationary, where people are saying, oh, we're going to cut back, margins are being squeezed, our earnings are being squeezed. Well, again, kind of going back to the growth versus value stocks, if earnings are being squeezed because of deflation, well, we've already had earnings kind of squeezed for value stocks because they're only trading at a PE of, we'll say 10, where growth stocks are trading at a PE of 20. That means for value stocks to lose 20% of earnings, so now they got a PE of 10, now we're going to have a PE, was that 12 or 12 and a half? Yeah, I guess 12 and a half, right? No, 12. On the same earnings, because the earnings drop, not the same earnings, but the earnings dropped by 20%. We had a PE of 10, now have a PE of 12. I mean, yeah, that's about right, 20%. Whereas a growth stock that had a PE of 20 and now is dropping by 20% of earnings will have a PE of, I guess that'd be 24? Yeah, 24. So the growth stock increases price to earnings ratio from 20 to 24, a $4 increase, where the value stock increases price to earnings ratio from 10 to 12, a $2 increase. Kind of like when we talk about Social Security cost of living adjustments, you make more if you have a higher beginning PIA with every 2.6% cost of living adjustment. If I have a $2,000 Social Security payout, a primary insurance amount of $2,000, and they raise my benefit by 3, we'll just say 3 because it's easier to calculate this big old head, that's $60. $60 I'm making. 2.6 increase on $2,000, 3% increase on $2,000 pays me $60. A 3% increase on $1,500 pays me $45. That makes sense? So for every year, now I got a $2,060 Social Security benefit, and now a 3% increase pays me whatever that is, $62. Whereas the other hand, I got a $1,545 payout, and a 3% increase pays me whatever that is on the. But it's always a greater amount, and it just widens, that gap widens more and more and more with the higher amount that you're starting with. And again, going back to price to earnings ratios, if I have a 10 and I drop my earnings by 20%, my PE is 12. If I have a 20 and I drop my earnings by 20%, my PE is 24. So I've taken from a 20 to 24 or a 10 to 12. And if you're looking at historical valuations, 24 looks a hell of a lot more nosebleeder than 12 by far. Whereas 20, well, that's still trading within spitting distance of the average, about 15 and a half or so. But now we're getting up to 24, and another 20% decrease would be, what's it, 20, I don't even know what it is, 29? That's definitely nosebleed. No one would argue that's not nosebleed. So that's why I'm a value investor for both deflation and inflation, because both could come get you. But at the end of the day, there are still going to be profits to be made in stocks, without question. Valuations matter. You got to understand how valuations work. The lower the valuation, the less it can drop, the more upside there is. There is more risk. Inherently, that's why you get more upside. You're taking on more risk, because the valuations being down might mean they're down for a reason, i.e. they could go to zero. But as long as a company is still making money, still paying a decent dividend yield, Valuations are still low. Inflation or deflation, be damned. It has more upside potential, most likely, not on every occasion, than a high stock price to earnings ratio. I hope this helps. All right, we'll see you next time.